Welcome back to our discussion of Chapter 6, Part 2. So we left off where we were calculating for Harvey Company the unit product cost under both absorption and variable costing. And this was calculated on the assumption that we were producing 25,000 units annually. So for the example to follow, just keep in mind the unit product cost that we've calculated under absorption is $16. And the unit product cost that we've calculated under variable costing is $10. That difference of $6 being the fixed overhead that is included in the calculation for product cost under absorption costing. So we're going to take all of this information and apply it to a situation, specifically this one down below. It says, let's assume the following additional information for Harvey Company. 20,000 units were sold. Of the 25,000 produced, there were 20,000 units sold during the year at a price of $30 each. There is no beginning inventory. So just so we know, if we didn't start with anything for the year, we made 25,000, we sold 20,000. That means by the end of this year, we would have 5,000 units left over. So let's start with variable costing and see what that would look like. So let's first calculate our sales. So if we're selling 20,000 units at $30 a unit, that means our sales for the year, that's going to come out to $600,000. But now we want to figure out, because remember with the variable costing, we do the contribution format income statement. So remember, it's always sales minus all things variable first, then our fixed expenses. So let's first find the variable expenses. So the cost of goods sold, remember, we sold 20,000 units, but remember the unit product cost under variable costing, remember that was the $10 we found up above. So the cost of goods sold, if we sold 20,000 units, we need to multiply those 20,000 units by the $10 per unit of product cost that we had calculated out. So 20,000 units times $10 a unit of product cost that we have found, which that $10 includes direct materials, direct labor, and variable overhead per unit. 20,000 times $10 a unit, that's $200,000 in variable cost of goods sold. The variable selling and administrative expenses, let's just go back up to the top here to see the variable selling and administrative expenses. That is $3 per unit sold. So we're going to go down here and find the variable SAG expenses. So we sold 20,000 units, and it's costing us about $3 per unit sold in terms of those selling and administrative expenses. 20,000 units times $3 a unit, that gives us $60,000 of variable SAG expenses. And furthermore, we're going to look at our fixed expenses. So the fixed overhead, that's the $150,000. And the fixed selling and administrative expenses, that's $100,000 a year. So we're going to take all of this information and we're going to set up an income statement like below. Let's zoom out just a little bit here. So our sales of 600,000 we have here, less your variable expenses. We first list the variable cost of goods sold, which we know is 200,000. Minus the variable selling and administrative expenses we know is 60,000. So sales minus all things variable, that gives us a contribution margin of $340,000. Minus all of your fixed expenses. The fixed overhead is 150 and the fixed SAG is 100,000. So after we subtract out all of our fixed expenses, we're left with a net operating income under variable costing of $90,000. So the big thing to keep in mind here is this fixed manufacturing overhead. Under variable costing, it's being expensed out. The entirety of the amount is being expensed out in total each period. So that $150,000 is being subtracted out right away to get our net operating income. Where with absorption, which we'll see in a second, the fixed overhead is not expensed out right away. Instead, it's included as part of the cost of goods sold calculation. So fixed overhead is expensed out under variable costing, but under absorption costing, it's inventoried. It's part of inventory. It goes into work in process and then flows through to finished goods as soon as those units are completed. So let's take all of the same information and see what that would look like under absorption costing. Remember, the product cost per unit is $16 under absorption costing from our calculation from before. So let's do our calculations. So sales, remember, we're still selling 20,000 units at $30 a unit. So the sales amount doesn't change. The sales amount is still $600,000. The cost of goods sold, however, that's what's going to be different, because here the cost of goods sold includes variable and fixed elements, where under variable costing it's just the variable cost of goods sold. But we know under absorption costing that the product cost includes fixed manufacturing overhead. So we sold these 20,000 units, but the cost per unit to produce under absorption costing, remember, that's $16 instead of $10. So we're going to do 20,000 units times $16 a unit of product cost. That gives us a cost of goods sold of $320,000. So again, just keep in mind that includes direct materials, direct labor, variable manufacturing overhead, and fixed manufacturing overhead. Okay, so we are attaching all of those costs to those units. So keep in mind, we only sold 20,000 units. We produced 25,000 units. So 25,000 units were produced, 20,000 were sold, leaving us with 5,000 units left over in inventory. So the important thing to keep in mind here is that if we produce 25,000 units, so in finished goods, when we finish those units, when we were finished with production, what costs go into finished goods? It's direct materials, it's direct labor, it's variable manufacturing overhead, and it's fixed manufacturing overhead. So remember from before, what did we say is the only thing that causes costs to flow out of finished goods? For a cost to flow out of finished goods, we need to make a sale. And when we make a sale, the costs in finished goods flow to an account called cost of goods sold. So the only thing that causes this to happen is for a sale to be made. So the units we produced have all these costs attached to them, and then as soon as we sell them, those units flow through, or those costs flow through to cost of goods sold. So in this case, we didn't sell everything we made. We had 5,000 units left over in inventory. So just a side note here, which is important. These 5,000 units that are left over in finished goods inventory have its own direct materials, direct labor, variable overhead, and fixed overhead attached to those units still sitting in inventory that never flowed through to cost of goods sold in this year. So you're going to have fixed manufacturing overhead costs deferred in inventory in this situation under absorption costing, where under variable costing, when we produce those units, it's only direct materials, direct labor, and variable overhead that is inventoried. The fixed overhead is expensed out right away. It's never even touches inventory. It's never considered part of assets. But under absorption costing, it is. So in the event that you don't sell everything that you made and you have units left over, you're going to have fixed overhead along with these other costs, but you're going to have fixed overhead from this period stuck in there that won't be released into cost of goods sold until a future period when those units are finally sold. So just an important point there. You'll see how that is going to be relevant as we look ahead. So we found sales. We found cost of goods sold under absorption costing. Now let's look at our SAG expenses. Remember, the fixed SAG expenses, that's $100,000 a year. And the variable SAG expenses, remember, that is $3 per unit sold. So we sold 20,000 units, and each of those units are costing us $3 per unit in selling and administrative expenses. $20,000 or 20,000 units times $3 per unit, that is going to come out to $60,000 in total variable selling and administrative costs for this year. So we're going to put all of that together in our income statement here down below. So the sales, remember, that hasn't changed. So the sales, that's still $600,000 regardless of the costing method that we're using here. The cost of goods sold, that's $320,000. Remember, our traditional income statement, it's sales minus cost of goods sold gives us our gross margin. So the sales of 600 minus the cost of goods sold of 320, that gives us a gross margin of $280,000. Minus our selling and administrative expenses, both the variable and fixed, that gives us an overall net operating income of $120,000 there. So we can see here, depending on the same situation, but depending on whichever income statement or costing method you're using and which income statement you're setting up, in this case, although it's the same situation, they yield different net operating incomes. Under variable costing, we had $90,000 of net operating income, and under absorption costing, we had $120,000 of net operating income. So that's a $30,000 difference. And that $30,000 difference, where is that coming from? That's coming from the fact that we, in this case, ended up with units left over in inventory at the end of this year. And those ending units have cost attached to them under absorption costing that they don't have attached to them under variable costing. So we're going to pause here and continue on with the part 3 video to see how to do the reconciliation of these two net operating incomes when comparing variable costing to absorption costing.